When stepping into the world of trading, whether in stocks, forex, cryptocurrency, or commodities, it can feel like navigating a vast ocean without a compass. Many aspiring traders dive in with enthusiasm, but quickly find themselves overwhelmed, frustrated, or losing money. Why does this happen? One of the most common reasons is the lack of a well-defined trading strategy. In this video, we'll explore why having a trading strategy is critical to success in the financial markets, how it can be your ultimate tool for achieving consistent profitability, and lastly, show you a profitable trading strategy with a very high win rate that can be used on any time frame for intraday scalping or swing trading. So make sure to watch the video to the end. A trading strategy is a systematic plan that guides your trading decisions. It defines what to trade, stocks, forex pairs, cryptocurrencies, when to enter, the conditions under which you initiate a trade, when to exit, criteria for closing trades to lock in profits or limit losses, how much to risk, the amount of capital you're willing to put at stake. Think of a trading strategy as a rulebook that removes guesswork and emotional decision-making, enabling you to approach trading like a disciplined professional. Trading without a strategy is akin to gambling. Here's what can happen if you skip this vital step. Without a strategy, emotions like fear and greed can dominate your actions. For instance, you might hold on to losing trades too long, hoping they'll recover, or exit winning trades prematurely out of fear of losing profits. Random trades based on gut feelings or tips often lead to unpredictable outcomes. You may win occasionally, but the lack of consistency will make long-term success nearly impossible. Impulsive trading without a clear plan can lead to overtrading, where you take excessive risks or make trades that don't align with your goals. A lack of defined risk management often results in significant losses. One bad trade could wipe out weeks or months of progress. The psychological toll of trading aimlessly can lead to frustration, burnout, and a loss of confidence in your abilities. If you believe I'm missing out on anything about the dangers of trading without a strategy, then do the community a favor and comment down below. We appreciate and value every input.
My head. Oh no, you can't touch me. Oh, I hit my head.
Here's how a trading strategy can turn chaos into clarity and make the difference between success and failure. A well-defined strategy acts as a roadmap, giving you clear guidelines on when to act and when to stay out of the market. This structure reduces impulsive decisions and keeps you disciplined, even in volatile conditions. With a strategy, you're less likely to make emotionally charged decisions. By following predetermined rules, you can stay calm and focused, even during market fluctuations. A good strategy includes risk management rules, such as setting stop-loss orders and position sizing. These help protect your capital and ensure that no single trade can cause irreparable damage to your account. Consistency is the cornerstone of long-term trading success. A strategy ensures that you're making decisions based on proven criteria, which can lead to more predictable and reliable outcomes over time. When you have a strategy, you can track and analyze your performance over time. By identifying what works and what doesn't, you can refine your approach and continuously improve. Knowing you have a plan can boost your confidence as a trader. You'll approach the markets with a sense of purpose, knowing that your decisions are backed by logic and preparation. To build a robust trading strategy, consider including the following components. Fundamental analysis, example economic data, earnings reports. Technical analysis, example chart patterns, indicators. Define specific conditions for entering and exiting trades. For example, buy when a stock crosses above its 50-day moving average. Sell when RSI exceeds 70, signaling overbought conditions. Use stop-loss orders to limit losses. Limit risk per trade to a small percentage of your capital, example 1 to 2%. Determine how much of your capital to allocate to each trade based on your risk tolerance and account size. Test your strategy on historical data to see how it would have performed. Optimize it to improve results while avoiding overfitting. Markets are dynamic, so your strategy should allow room for adjustments based on changing conditions. If you're new to trading, developing a strategy can seem daunting, but it doesn't have to be. Follow these steps. Begin with a basic strategy focusing on one market or asset class. For example, day trading a single forex pair or swing trading large-cap stocks. Study proven strategies used by successful traders, but adapt them to suit your personality and risk tolerance. Fact-test your strategy using historical data, then try it on a demo account before risking real money. Developing a reliable strategy takes time and practice. Don't rush the process or expect overnight success. Now, for making it this far in the video, I want to reward you by showing you a hidden strategy that I've developed that works in any market. Yes, any market, whether it be crypto, stock, currency, commodity, indices, or even synthetic indices. This is possible because the strategy is comprised of 2 to 4 popular indicators that you can find on any established trading platform. Before we continue, please understand the reason why I said 2 to 4 indicators is because the basic strategy comprises 2, which constitute the entry conditions, while the additional 2 act as filters, making the strategy more refined by filtering low-probability trade setups. However, each additional indicator makes the strategy more complex with fewer entry opportunities. The chart you are currently looking at highlights trade opportunities that would have been won, indicated by the respective arrows, and trades that would have been losses depicted by the red X. But we will get back to this in a bit.
And everything will be all right. No, I'm okay. Yeah, no, I'm okay. No, yeah.
So without further ado, let's get to it. The first indicator that you would need is the exponential moving average. The period for the moving average is 100, set to the close. The next indicator that we need to add is none other than the Ichimoku Kijun Sen. Once you add the Ichimoku, it's initially going to look like this. But we do not need all this, we only want one part. As such, we are going to hide all the components, except for the Kijun Sen, which is set to a period of 26. After that, your chart should look like this. A buy condition is met when the Kijun Sen is above the moving average. Next, the previous candle close crosses above the Kijun Sen. Here's an example. For the sell condition, make sure that the Kijun Sen is below the moving average, indicating that the market is in a downtrend. Enter the trade once a candlestick crosses below the Kijun Sen like what you see now. Now that we've added the 2 most important indicators, let's look back at the chart that was previously shown, but this time with both indicators on the chart. As you can see, this strategy generates a lot of signals as the market trends, with most of them being winning trades, some of which can go over 100 pips. But of course, the win rate can be subjective, like for example, the 2 entries you see here. Notice there is both an arrow and a red X. This is because, depending on the size of the stop loss a trader uses, the trades can be either a win or loss. Speaking of losses, I'll show you how you can filter bad trades, not just with this strategy, but with any strategy using the third indicator, the stochastic oscillator. With that in mind, please note that you will change the settings as follows. K% length, 3 K% smoothing, 3 D% smoothing, 14. This will make the stochastic a lot more smoother. This is where things get tricky. Because this is a trend trading strategy, what you would want to do is follow the trend in the immediate higher time frame. For example, if you are using this strategy on the 15-minute time frame for entry opportunity, you would use either the 1-hour or preferably the 4-hour time frame to know the general direction of the market. In my case, since I'm using the 5-minute time frame for entry, I'll be using the direction of the 15-minute time frame. Now watch carefully how to filter bad trades with the stochastic oscillator. Once you get an entry opportunity on your entry time frame, mine being the 5 minutes, I would go to the larger time frame, which would be the 15 minutes. You don't necessarily have to be as strict as me by following the trend direction on the larger time frame. However, what is important is the status of the stochastic. If a buy signal was given, the stochastic main line, which is the K%, must be above the signal line, the D%. Number 2, make sure that the stochastic was recently oversold and is now heading in an upward direction, meaning to be overbought. For a better understanding, let's put this into perspective. think of the stochastic as a pendulum that swings from one extreme to the next. In Forex trading, these extremes are called overbought and oversold. When the pendulum swings to the extreme left, the momentum will inevitably become exhausted only to swing to the extreme right, and the cycle repeats itself. So in that case, if the market was recently overbought and is now actively going into an oversold condition, placing any buy trades would not be wise, as the indicator is telling you that the market is in a retracement on the higher time frame, or possibly worse, its start of a new trend in the opposite direction. Now let's take a look at how many of the bad trades we would have filtered out with the stochastic oscillator. Of course, this would also reduce the amount of winning trades as well. This is inevitable, as the greater the number of conditions you have for an entry, the fewer the trades, but the higher the quality of the trades. Now, if you want to be even more meticulous with your trading, then you can even add a fourth indicator, which would be the average directional index. This would be best applied to the larger time frame like the stochastic. But with this one, if a buy condition is given, you would check to make sure that the D+, which is the green line, is above the D, the red line. This would mean that the market is in a strong uptrend and there is momentum in the market, thus increasing the probability of that trade winning. With a sell signal, make sure the D is above the D+ to indicate a strong downtrend. As regards the take profit, a trader can use several different options, but the most effective take profit strategy is one that has multiple take profit levels. For a better explanation, allow me to demonstrate. With an account balance of $2,000, I would like to use a lot size of 0.3 mini lot, 3 entries with a lot size of 0.1 each. Also, because of the time frame that I am using, my take profit targets are going to be as follows. Target 1, 10 pips, $10, target 2, 25 pips, $25, target 3, 50 pips, $50, or you can let it run with a trailing stop. For risk management purposes, your stop loss can be set to about 20 to 40 pips. Yes, I know, in a scenario where the profit hit all 3 take profits, your total gains would be $85. While in another scenario where no targets were hit, your total loss would be $60 to $120.
I say, hold up, wait a minute, something ain't right.
But if you know anything about scalping strategies, they always have small gains, but big losses. But for that strategy to be feasible, the gain's cumulative total must be greater than the total losses. Pro tip, another way to effectively manage your trades is to break even the last trade when target 2 has been hit. Or you can break even after target 1 gets hit, but this would increase the chances of being stopped out significantly, and only for the market to head in your desired direction afterward. In this case, the wins would be too insignificant to cover the losses. So now that I've done my part in sharing the trading strategy with you, it's your turn to return the favor by making this video go viral, by clicking the like button and commenting on your thoughts about the strategy. I'd appreciate it greatly. In trading, success doesn't come from luck. It comes from preparation, discipline, and having a clear plan. A well-crafted trading strategy serves as your foundation, guiding your decisions and helping you navigate the complexities of the financial markets. Without one, you're left vulnerable to the whims of the market and your emotions. So before you place your next trade, take a step back and ask yourself, do I have a strategy? If the answer is no, it's time to build one. The effort you invest in today will pay dividends in your trading journey for years to come. Would you like to explore specific types of strategies or tips for implementing them? Let us know in the comments. Don't forget to like, subscribe, and hit the bell icon for more insightful trading content. Thank you for watching.